Position trading. I have a lot of people that are interested in position trading, and a lot of the people are those who are first interested in the foreign exchange market as intraday traders and come to the realization that maybe they're not that interested in trading every single day and just want to keep an eye on the market because it has that addictive nature about it, and they decide that they just want to participate in some position trades, be it in cash positions or leveraged positions or margin positions. Um, but there are two effective ways to enter into position trades. I'm going to talk about both of them. One of them, just to summarize, is one of the ways is to simply have a short-term intraday or medium-term position evolve into a long-term position as a result of a good entry and good position management. The other way that position trades can be entered are simply by watching the long-term charts, having and having a good understanding of what's happening in the market and global economics, and entering position trades on that basis. Or of course, this includes, of course, the technicals and the COT data as well. Now, here I've just summarized the two different manners in which you can decide upon or enter into a position trade, and you can read through that because we're going to be walking through that in any event. And here's just an overview of the strategies to be employed on the short-term entries. So the first one we're going to talk about is having a position trade evolve from a short-term trade entry, and there are some rules around it that must be complied with, and that goes back to your position management. If you manage your position effectively, you can get into a really nice position trade, because the statistics that we have found are that about 1 in every 10 to 15 short-term trades can evolve into a long-term position trade that will pay about 2, 3, 500, 600, 700 pips in the end. But you must manage your trade effectively, applying the proper use of your tools. So let's just, as a quick overview here, let's just assume that we have a price comes down here into consolidation, and we've defined a key level, hypothetically speaking, of course. We've defined a key level, and we get a real good order entry here at the base of the key level. And then as price starts to rally, what we do is we simply manage our profits, and we take profit on, say, 70% of our position at the first profit target, and time will elapse. And one of the biggest challenges that people have with position trades is that they are uncomfortable with time. Again, and I've said this before, but you just have to be entirely willing to submit to the market and the market's timing. And submission is not an easy thing for human beings, but the financial markets require submission, discerned submission we call it, okay? Prudent submission. And so as time elapses, we'll see price swing up and down, and it might even move, well below and start to get pretty close to where our stop is. And in fact, it may get very close or to below our stop before price continues to move up. But we must keep an eye on our longer term time frames to make sure that the market is still within our technical parameters that are supporting the trade that we decided on in the first place. Now, what we'll do is we'll manage our position effectively, and maybe you'll take another 20% of your profit after the next leg up, after the second leg up, and you'll leave 10% of your position in the market. So if you're trading 100K lots and you've taken profit on 90 on 9 of the 100K lots, you still have 100K in the market. Now what if it moves another 300 or 400 pips? You'll make more on that 300 or 400 pip move than you did on your initial 90% of your position. And now the idea is that your equity will be based on your original position, your original 100% position. You'll only have 10% remaining. But if you want to make new trades, you certainly can, but the new trades and the decision to make a new trade or a new entry has to be based on the available equity that you have and has to be viewed as a whole new trade altogether. All right, it's a whole new trade. And if you get yourself into one of these long-term positions and you want to trade against the long-term position, you certainly can do so in another account. And these accounts definitely lend to that type of strategy as well. Where do I place my trailing stops? Well, your trailing stops you can either, as the market continues to make new highs, you can trail it with Fibonacci levels, or you can trail it simply with support and resistance levels. Or you can also trail the market using your daily ranges. And we're going to go through an indicator called average true range, and you can leave your stop below or beyond the daily's average true range with the anticipation that the price will continue to move up. Also keep in mind that you may see several down legs or a series of several days that move in the opposite direction that you want the market to move. But again, that brings in the factor of time, and you have to be submissive to time. Let's walk through an example here. Say we have a level of support here, and we have the previous day's low, and we just decide that we're going to make an intraday trade. We have a MACD convergence here on the 60-minute chart, and this level of support is S1. We decide to make a long trade right here at the base level of support. Now, the market, say price comes down to 26.60, and let's say we make a long trade at 26.70. Price moved up here to 2,730 pips already in one candlestick. Then we consolidate, but look how deep it comes back. It comes back almost to your entry. Price finally then breaks through, and as it breaks through, you'll have a new profit target based on support and resistance in the past, or it may be price projections or Fibonacci levels. And then we decide that we're going to take some more profit. If we take, say, 70% out at first profit target, and then 20% out at the next profit target, and then we leave 10% to ride into the future. Again, here was our entry. I'm just scaling back on this chart as time has elapsed. Here was our entry. Our first profit was here, and our second profit was up here after price had traded above resistance. Our second profit was here. This green line represents R2. The red line is our central pivot. And we leave 10% to ride. So right now we're at 2,800. We entered at 26.70. Now we're at 2,800. We're up 130 pips. And as we watch, here's 2,800 here. Price continues to rally. Look how much it spikes down during this period to the 10-day moving average, and then continues to move up. Now, you can trail your stop. You can simply move your Fibonacci lines up and trail your stop behind your Fibonacci levels. You can stay beyond the range. You see here how we have the central pivot, S1 and S2. You can keep your stop beyond the daily range as price continues to move up. This was a non-farm payrolls spike, and this is good because if you are in a trade entering into a non-farm payrolls, then if you're carrying a position in the long term into non-farm payrolls, then you've built in a cushion. We're already up a couple hundred pips at this stage, so you have enough cushion to allow price to do what it does during non-farm payrolls and respond in a very volatile manner. And in this case, price continues to move favorably and our profits increase on the trade. Your other alternative is to look for a reversal pattern or a potential reversal pattern that may threaten your trade, and you can get out as you see the reversal pattern potentially coming to fruition. Now we're at 129.60, and keep in mind here, you see our price moved from 130 to 128.40. That's 160 pip give back on the move, and you have to mentally prepare yourselves to experience a lot of give back throughout the course of the trade, because it's not going to go and continue to go in one direction in your favor without retracement. Price moves into this ascending pennant scenario, and then we break out and we move up to 130.50, and in the time being there are a multitude of trades that can be made in this scenario, whether it's with your long-term position or against it, and you certainly can participate in those trades on a separate account unless you have a certain type of hedging feature on your platform. We are now up by 360 pips over a period of 14 days, and as long as you don't sit here and stare at the position or check it every hour, then you should be okay. You should stay in your position. If you just close your computer and walk away and open it, set your stop and open it in a couple of days, then you may make more money. So just to give you another example here, this is a head and shoulders formation, real nice head and shoulders, and the retracement comes to our central pivot. And if you bought here at the central pivot, hypothetically speaking, I'm not getting into the analytics on this, we had a divergence at the head, but if you bought here at the central pivot, you see this aggressive spike right here? That should pay you your first profit. The idea is to get spiked out and take your first profit as soon as possible. Price comes all the way back before continuing upward and giving you an opportunity to take your second profit. As we see this head and shoulders formation, we now have muscle and strength moving in the new direction, and to hold on to a percentage of your position would be prudent. What I want to point out, this is a British pound daily chart, and what I want to point out on this chart is let's say that you identified a reversal point here. We have a nice railroad track, and we see this failure high spike, and assume you entered, let's say here on this retracement. Just to give you a bit more background on this, this is a British pound rally as a result of a nice widened interest rate differential to the U.S. dollar. As well, there the U.S. zone had some poor economic data, a string of poor economic data that had been coming out, and their currency had been falling. Sorry, I just had to get that. That was my mom. Just making sure I'm okay. So the U.S. dollar had a string of poor economic data. Anyway, the double deficits and so forth, and price moved to a parabolic level. And at this point, all of the economists were calling for the British pound to go to 2, and there was an overwhelmingly strong sentiment of U.S. dollar selling happening at the time, and British pound strength, and the interest rates were quite a bit higher in the UK, At that point, you want to look to start selling. When there's an overwhelming sentiment in one direction, you sell into that sentiment or against the sentiment. Anyway, let's just say that we entered the market here, short, and we held onto a position for 800 pips. And we had managed a position and we had taken some profit along the way, and we held on to it for 800 pips, and then price begins now to retrace, because it will retrace. Price moves up, down, and sideways. We retrace now 300 pips. What's important for you to understand before you enter into position trades is that the market will do this. It will give you 800 pips and then take back it'll give back, in this case, 500 pips it gives back. I'm sorry, 500 pips it gives back. So you move from plus 800 to plus 300, and just let the market do its thing. So we move into this consolidation, then it breaks out. Now we're plus 1300 pips. Plus 800, then you're only plus 300, now you're plus 1300. And there are, of course, countless interim swings along the way that are going to test your patience and test your mettle and your trading savvy. But we simply have to follow the technicals. And if we follow the technicals, we see a long-term head and shoulders pattern here as price comes up and forms a double top at the right shoulder. And things like this rejection and then this rejection should suggest to you that, and this rejection, that price is going to continue moving in your favor. And there are countless other confirmations that will move along the way. The nice thing about these long-term position trades is that you will certainly have your fair share of confirmations, either to the positive or to the negative. And here we just have a dialogue explaining it for your future reference. Just to summarize, there's really no standard or definitive rule to scaling out of trades. You can create your own formulas if you want. I've just given you some ideas to work from. Nothing in trading is definitive. Scaling out of trades requires absolute discipline and discernment based on what the market is telling you, and how you manage your stop will be key to whether or not you're profitable. Here are some various ideas as to that you can apply to your scaling out of trades strategies, and just some rules to help you to define your own scaling strategies.